It's Brian Preston, the Money Guy.
Dave doesn't balance risk and return. That sounds kind of harsh, Bo.
Yeah, I feel like he doesn't, at least in the way that he describes an investment, he doesn't understand the risk and return trade-off. So what can you do? You can understand that, generally speaking, there is a risk and return trade-off that does exist in the financial marketplace.
So when you're learning like investment management 101, they talk about the efficient frontier.
Sure.
They talk about that the further out the risk spectrum you go, the better rate of return you're anticipating. That's why, if you think about it, when you're a young investor, when you know you won't touch that money for 30 or 40 years, you ought to be wild. You just ought to be crazy. You ought to also should celebrate the volatility that comes with that. But we know over time things change. We'll talk about that in a little greater detail as well. But I want to focus on first, if we're going to take risk, meaning if we're going to be a bear, we're going to be a grizzly bear, how do we get the most return for all this risk we're willing to take?
And this is what Investopedia says. They say that the risk-reward trade-off is an investment principle that indicates higher the risk, the higher the potential reward. Well, remember, if you look at Dave Ramsey's investment strategy, it was 25% large cap, 25% mid cap, 25% small cap, 25% international. No fixed income, 100% equity portfolio, and it's a 100% equity portfolio that invests in more aggressive equity asset classes. So if it's further out there on the risk spectrum, the return ought to be better.
So you're thinking like a 20-year-old who can really go wide open on the risk. This thing's probably killing it long term, right?
Right.
Guys, there's a trade-off. I'm telling you, we compared this to just the boring old S&P 500. And a lot of you guys, wait a minute, Dave uses active managers. What did you guys use? I will tell you, to do this analysis, we did have to assume, because we know that the 4 different groups that Dave used, we were very generous and we let Dave's asset investment use the index fund. Because like we said, between 82 to 87% of active managers underperform. So I felt like we were being quite generous letting Dave's portfolio use the indices for this analysis.
So what we set up is, let's see if 25% in the large cap index and 25% in the mid cap index and 25% in the small cap index and 25% in the international index, does it actually equate to a better risk reward trade-off than just buying the market, just going out and buying the S&P 500?
So when we look at the raw performance, we did highlight this. This is from Morningstar.com. We put this in. This is as of, so you don't think we cherry picked. This is as of June 30th. I mean, this is the most recent period that we could go grab a month end to do this analysis. And you quickly see, if you look at the 3-month, if you look at the 1 year, 3 year, 5 year, 10 year, that 4-prong approach that Dave recommends compared straight up to the S&P 500 underperforms in every one of the time periods.
Said a little bit differently, an investor over this is a 10-year time frame that you're looking at, would have been better served, instead of doing Dave's philosophy, just going out there and buying the market, just buying the S&P 500.
So we went a little deeper because like we said, we want you to understand, what is your financial advisor's job? They are to make sure you're getting the best risk-adjusted rate of return. Right. So it's not only absolutely how much money I can make, it's how much money can I make with a certain level of risk. Well, we've already agreed. This type of portfolio should be risk-on type investing. I mean, Dave is 100% equity investing, so this thing better be making money. We can already see performance. There's a little bit of a lag. How does it stack up when you look at risk and reward in that efficient frontier?
So if you're someone out there who's listening on iTunes, Stitcher, iHeartRadio, you may want to go to YouTube because there's a really interesting illustration on there, and this is what the illustration shows. It's an X and Y axis, and the further you move on the X axis from left to right, the more risk you're taking. The further you move from the y-axis, bottom to top, the greater your rate of return. Well, what you'll notice is three of the 4 asset classes or 2 of the 4 asset classes that Dave recommends are taking a lot more risk than the S&P 500, but getting a much lower rate of return. The third of those is taking less risk, but also getting a much lower rate of return. The only redeeming asset from a risk and reward trade-off relative to the S&P 500 is, in fact, the S&P 500. It's the one that's actually on the efficient frontier.
So for those listening, or those who even are seeing this visual that we have up on the screen right now, according to this, because we have all 4 holdings and then we have the total Ramsey portfolio smashed together and we put arrows to draw attention, Dave is taking more risk, but getting less historic rate of return. That's not good. There's 4 quadrants here. There's the quadrant to the bottom left. That means you're taking less risk, but you're also getting less rate of return. You kind of expect that. When we're dealing with bond investments or safe risk-off investments, you kind of count on them to fall in that bottom left quadrant. Where you want your risk assets in the upper right quadrant, because that means you're taking more risk, but you're getting a better rate of return. Where 2 of Dave's 4 investments fall is to the right of the S&P, meaning they're taking more risk, but they're underperforming. That's no man's land. You do not want your portfolio to be in the more risk, less return category historically. That means that you're just not risk efficient.
It's inefficient from a risk and reward trade-off. That's exactly right. So one of the other things we thought we'd look at is, okay, well, what if we kind of stress test both of these? What if we kind of look at how do these 2 portfolios look in the best of times and in the worst of times?
It was kind of interesting because you can see we highlighted the worst is because it is a noticeable difference. These same time periods, but noticeable difference performance. Bo, I don't mind just focusing on the 1 year and 3 year. The 1 year, like Dave's worst 1 year was lost about 18%. It's 17.79, and it's right around April of 2019 to March of 2020. The S&P 500 during that same period only lost 7%.
So that's 10% around underperformance just in really the last year, because this ended in March of 2020. If you extrapolate that and look at the 3 years, the worst 3 years that Dave Ramsey's portfolio would have exhibited was losing 1.5% per year from April of 2017 through March of 2020. The S&P 500, the worst it would have performed, is actually annualizing 5% per year.
A return, not a loss.
Yeah, they were actually making 5% per year over that 3-year period.
So, I mean, look, Dave's portfolio, I think for an aggressive investor, it's not going to destroy you. I'm just saying that risk adjusted, there might be a better way.
If you're going to be aggressive, there's probably a better way to do it than implementing Dave's portfolio.